morning, everyone. Thank you all so much for coming out to the Spring 2019 Multicoin Summit. We're incredibly excited to host you this morning. We've got a lot of awesome content to run through. Just a heads up, we're covering a lot of content in this presentation, so strap in. We got to make it to the moon and back in about 30 minutes. All right, so everyone, a lot of people like to talk big things about crypto. It's going to change the world. Governments are going to collapse, yada, yada, yada. They like to exaggerate a lot. And you see a lot of people have written theses on why crypto is going to change the world. Well, we've read basically all of those theses, and actually we think they're thinking too small. We think no one has yet actually really articulated just how large and how diverse the array of opportunities are for crypto. And so this morning I'm going to walk through what those three fundamental opportunities are. Before I do that, though, I want to talk a little bit about trust, because trust is the foundation of society and the economy, and by re-examining trust assumptions, that's how crypto can tackle such large markets. Every day, we trust tech giants with our data. We trust banks with our money. We trust insurance companies with, to protect us in case anything. We trust insurance companies in case anything goes wrong. We trust governments to protect us, among a number of other things. We take for granted just how much trust there is in the economy because all of these trust assumptions are fundamentally invisible. They operate in the background and we don't see them. When we're born with certain trust assumptions, we don't even question them anymore because they've been there since we were born. And so this is why it can be hard to understand just how large the opportunity is for crypto and why people like to say such big things. These trust assumptions are just embedded in society. For the first time, using open networks bounded by free market economics and cryptography, we can actually incentivize human behavior and coordination at a global scale without introducing any new trusted intermediaries. This was never possible before, and this is what's going to enable crypto to be one of the defining technologies of the next few decades. This represents, though, a very subtle shift, and this is what's going to enable us to change so many industries. To be fair, we're not necessarily saying that trust is a bad thing. Trust is good in a lot of ways, and it helps society work. What we are saying, however, is that by creating an economy and a society with fewer trust assumptions, we can ultimately create a world that's more resilient to change and is less fragile. Okay, and so with that, let's jump into these theses. I'm going to go over these in the order that we expect these to play out over the next decade or longer, and in terms of their aggregate market size and market impact. So the first we're going to talk about is open finance. The open finance revolution is really about the ultimate vision of the open finance vision is that we'll take kind of Mark Andreessen's famous saying of software is eating the world and apply that to money and finance in a fundamentally new way that was not possible before. Next, we'll touch on Web3. Web3, the ultimate is about empowering developers and entrepreneurs to build the next generation of applications in a way that they do not have to rely on Web2 monopolies anymore. And the ultimate result of that is going to be that consumers are much, much better off than they are today. And then lastly, we'll talk about the opportunity for a global state-free money. This is what often crypto enthusiasts talk about, kind of digital gold, and it's been hyped up a lot. We actually think most of the crypto enthusiasts who talk about this today understate this opportunity because the opportunity for a digital gold expands the market in a lot of ways from what we conceive of as the precious metals market today. Okay, and so with that, let's jump into open finance. The key to understanding open finance is to understand that this modularizes financial primitives. And the result of that is going to be the commoditization of trust and the disintermediation of middlemen. I know these are both abstract statements, and so over the next few slides, I'll walk through what each of these mean with some examples and explain how these are going to enable open finance and then why open finance will be so big. So to understand that, let's talk about three examples of protocols that are live today. These protocols are financial primitives. These are all live on the blockchain today. These are all just pieces of code that live on the blockchain. And so first, let's talk about 0x briefly. 0x is a protocol that allows any two parties to trade an asset, to trade a digital asset. Historically, if you wanted to trade digital assets, you needed a third party, someone who could act as an escrow to conduct the transfers between the two parties. That escrow agent would, of course, charge a fee, and both parties would be subject to the counterparty risk of that third party. The 0x protocol, by living on the Ethereum blockchain, once two people have signed messages saying, hey, we want to trade these assets, the 0x protocol guarantees that that trust will happen atomically and guarantees that either the transaction will fail or both sides will get their assets, and you don't need a third party. The second we'll talk about is Maker. Maker is a protocol that allows people to take assets they own, such as Ethereum or Ether, deposit it in a contract, issue debt against that contract, and that debt is a stablecoin called DAI that's pegged to the US dollar. And the third primitive we'll talk about today is Augur. Augur is a protocol, as Tushar mentioned earlier, for decentralized prediction markets. So this protocol allows people, anyone in the world can create a market for anything, and then they can create shares on the outcomes of that market, trade those shares, bet on them, and then ultimately the Augur protocol will actually resolve those markets. So the key to understanding what we mean by these being primitives is by looking at the applications building on top of them. So first here we've got two examples of companies called Ethernex and Radar Relay, and they're built on top of the 0x protocol. Again, the 0x protocol is not a company. The 0x protocol doesn't know what laws are. The 0x protocol does not have a marketing budget. It does not offer customer service. So these companies build exchanges where buyers and sellers can find each other, agree on a price. These exchanges also market the customers, and they deal with local laws and jurisdiction, and then they use the 0x protocol as a way to settle trades in their respective ecosystems. Right? So when we talk about these being primitives, that's what we mean. These companies build on these primitives. But what's cool about these primitives is that they're modular and that applications can leverage multiple of them. And so now there's also a handful of companies building on the Augur protocol, and these companies are all using the Augur protocol to create prediction markets, trade disputes, and resolve them. And some of those prediction markets are actually using the 0x protocol as well. And what's really cool is that in a few months, with an upgrade of the Augur system, all of these will also support trading using the stablecoin DAI out of the Maker system. And so what's amazing about this is that we have these three independent teams that have built these three independent pieces of code. They all have modular endpoints that have been exposed, and now we're starting to see the emergence of higher order applications building on top of these protocols. And so when we talk about the modularization of financial primitives, this is what we mean. We mean taking software and applying it to money and finance on a first principles basis in a way that simply was not possible before. Interestingly, if this analogy sounds familiar, that's because this kind of methodology has been the foundation of the entire modern internet, right? So as a simple example, if you consider email, all modern email clients are based on a lot of open protocols and standards. Things like SMTP, which is used to deliver messages between email servers. If you run a client in your browser, it's probably rendered using JavaScript, right? And so in the same way that these higher order applications enable us to have the rich user experiences we have today, these underlying financial primitives or protocols will enable us to have more robust, trust-minimized applications on top tomorrow. Okay, so we just talked about the kind of key enabler here being the modularization of financial primitives. Next, we'll talk about how these really enable us to commoditize trust, disintermediate middlemen, and ultimately create financial markets that are truly global in scale. And to do that, we'll walk through another simple example. This is our friend Lee. Lee lives in China. He's a middle-class citizen. Lee would like to invest in the S&P 500, but Lee can't because he's subject to capital controls, and he cannot get his money out of China and invest in the US stock market and the S&P 500. Fortunately, Lee has heard of this thing called the UMA protocol. UMA stands for Universal Market Access. And the UMA protocol is a protocol that allows any two parties to engage in a contract for difference. So to understand what a CFD is, let's just consider, let's say Lee wants to go long and I want to go short, right? We can both, let's say the S&P is trading for $100 today. Lee and I can shake hands and say, if the S&P goes up $1, that I owe Lee $1, and if the S&P goes down $1, Lee owes me $1. And so we can neither of us have to actually buy the underlying asset or touch it, but we can just agree through this synthetic contract that we will take exposure to the price of this underlying asset. So the UMA protocol provides all of that infrastructure to allow Lee and I, or Lee and any third party, to engage in this synthetic contract, and then post collateral in the system, such that if the price moves $1, then the UMA protocol actually rebalances the balances between the two parties in real time. And so the power of this is that this contract is trust minimized, right? There is no counterparty risk. The protocol handles all of the rebalancing, and that both parties can know that they are going to get the outcome based on the underlying asset. And of course, UMA is on a blockchain, so it's global and has all of those benefits. Now, there's just one problem with the UMA protocol, and that's that it's a protocol. UMA does not provide an exchange for people, for buyers and sellers to come find each other or agree on a price. Fortunately, there's an exchange now called DDEX that has implemented the UMA protocol, and DDEX is a place for for buyers and sellers to come find each other and agree on a price. And so there's market makers now all over the world who are putting up buy and sell orders on the DDEX exchange, and there are people like Lee who can post collateral and engage in, can find these market makers, agree on a price, post collateral, and engage in these contracts. And using the UMA protocol, they are guaranteed to get the outcome of going long and short on the S&P. Again, this is all live today. There's just one other problem here, and that's that market makers are normally not in the business of taking on market exposure. Market makers are in the business of providing liquidity and charging a spread. And so that market maker then, as a more sophisticated trading organization, will go to the New York Stock Exchange, hedge out that exposure by going long on the NYSE, and now he can provide the service to Lee. And so this is the amazing thing about UMA, right, is that this is global in nature and enables financial inclusion. But this doesn't just work for bringing capital from developing economies into developed economies. We actually have the same problem in reverse. This is a tweet just a few days ago from one of our friends. His name is Spencer Noon. Spencer runs another crypto fund on the East Coast, and Spencer was trying to buy some Chinese equities, and he logged into his US brokerage account and found out that he could not do so. And so this problem of global financial inclusion, right, exists in both directions, between developing and developing economies. And so the real fundamental power of all of these open finance primitives is that they enable capital markets to become truly global for the first time. And they do this because these systems are permissionless, because they're censorship resistant, and because these contracts can be constructed in such a way such that there's no counterparty risk. This was impossible until just a few months ago, and this is going to help billions of people get access to global financial markets in a way that simply could not be done before. Now, it's worth considering, okay, well, there's a lot of incumbents who have a lot of vested interest in the status quo in charging fees and access in the ways that they do today. And incumbents don't typically like to just roll over and die. They like to defend the status quo. And so it's worth asking, how do these startups, how do these protocol teams make this new future happen? And so I'd like to talk about actually two of those incumbents today. One is JPM, and the other is Fidelity. It turns out, actually, incumbents oftentimes see disruption coming, and they often act on it. So JP Morgan today has rolled out a thing called JPM Coin. There are 220 banks now using JPM Coin to do settlement payments between these banks. And that number is growing. I think it'll be 300 or 400 by the end of this year. Fidelity is not really a bank, but more of an asset manager. Fidelity manages trillions of dollars of client assets, and Fidelity is now helping their customers buy crypto, store crypto, trade crypto through their existing Fidelity accounts. Moreover, Fidelity provides back office services to a lot of other financial advisors. And so by Fidelity building this infrastructure, they're going to enable all of these other financial advisors to also offer crypto type products to their customers. My point in bringing up these two examples is that incumbents oftentimes see the disruption coming, and that doesn't necessarily mean they're going to stop the startups. In fact, they usually don't. And so case in point, this is a website called Pathfinder.com. Pathfinder.com was launched in 1994, and it was an initiative put on by Time Warner. At the time, Time Warner owned ESPN, they owned Sports Illustrated, they owned Time Magazine, and Sports Illustrated. And so Time Warner realized in 1994 the disruptive nature of the internet to roll out a bundled magazine and news subscription service. And they did so, and it turns out it was a spectacular bust. My point in bringing this up, though, is that a few weeks ago, Apple just announced a comparable service. And between 1994 and now, we've seen a large array of new types of internet and media companies emerge. And those are the kinds of startups building both protocols and teams that we are investing in. And the rate of growth among these groups is really staggering. 18 months ago, open finance did not exist as a concept. Today, there are more than $400 million of capital locked in these open finance contracts. And we expect this to compound over the next decade, if not longer. We know enabling this open finance revolution is going to take a long time, but the opportunity ahead is large and will persist for quite some time. Okay, so we just covered open finance. If we think about on a technical basis, open finance, money is one type of data. And open finance was about applying this type of open logic and modularization to this one very specific type of data, in this case, money. Web3 then is really about expanding that concept and not just applying these same principles to money, but to all forms of data that we own. Health data, your notes, photos, pictures, whatever. So the way to understand this is to think about kind of the status quo. Today, if you probably use a lot of these different services, and in each of these services, you do not actually own your data. These companies own and control your data, and they do so on both a legal and a technical basis. On a technical basis, they control the databases where your content lives, and on a legal basis, those user agreements that no one reads, right, those give them control legally over your information. And so the ultimate vision for Web3 is to basically invert that model such that consumers actually own their own data, and they authorize application providers to view and interact with their data. The key thing to making this happen is that we need to unbundle data ownership and application logic. And the result of that is going to be self-sovereign data. Again, I know these are somewhat abstract concepts, so we'll kind of talk through them a little bit, and then we'll also talk through, I think, the biggest and most important question, which is why and how will Web3 win? Everything I just described sounds very ideological and like very in a nice world, but the reality is the Web2 monopolies, again, are not going to just give up. And so if we're going to take them on, like the question is how do they actually get beaten? And so the question really to understand that is to ask, well, where are the next generation of entrepreneurs and developers going to build their businesses? And they're not going to build their businesses anymore on top of the Web2 monopolies. We have seen this time and time again, right? Companies build, whether they're media companies, they're developing companies, creators, creatives, they build on top of these Web2 monopolies, they grow to a large scale, and then as the underlying platforms grow, they eventually turn on their platform complements and ultimately start competing with them. This has happened time and time again. As our friend Chris Dixon has said, right, over the last few decades, entrepreneurs and investors have realized that you simply cannot come to depend on the Web2 monopolies. They will always turn on you. And so this is the opportunity. And so just a couple of examples. First, I'd like to talk about Zynga. This is Zynga. You guys all probably remember Farmville from 8 or 9 years ago. Zynga was growing quite quickly, building games on top of Facebook. Zynga went public in 2012. And then just a few months later, right at the top of that chart, Facebook announced a change to their underlying newsfeed algorithm that deprioritized games. And Zynga collapsed and has never really recovered in a meaningful way. But this doesn't even just happen to large companies. This happens to startups and entrepreneurs too. Entrepreneurs like myself. I built my last startup, it was called Pristine. I founded it in May of 2013, and we built software for Google Glass for surgeons. I know Glass was never a very popular consumer product, but it was actually a really interesting piece of technology for surgeons because they work with their hands. So we launched the company right as Google started rolling out Glass. We grew, signed our first customers over that year, and by September of 2014, we raised our first venture round. 3 months later, Google killed Glass, and that effectively ended my business. You might reasonably ask, well, how did you guys not see this coming? Why didn't you talk to the Google team? Hopefully your venture investors called Google as part of the due diligence processes. And we did all of those things. We had a lot of phone calls with Google in the summer of 2014 because we were a little concerned about the lack of consumer adoption. We wanted to ensure for our own sake, and our investors wanted to ensure that Google was committed to the future of glass. And we called them, a lot of calls, and they reassured us time and time again that they were committed to the future of the platform. Well, then there was an executive shuffle at Google. The new executives came in, they changed course, and they pulled the plug on the project, and that effectively ended my business. That, by the way, is why I was so drawn to Ethereum in early 2016. I felt the plane of platform risk, and I realized I did not want to depend on the whims of some executive shuffle happening inside of a large company. So, case in point now, let's look on a go-forward basis. Who are some of these entrepreneurs and developers, and why are they not going to build on the Web2 monopolies? I'd like to talk about a protocol called Tari. Tari is a protocol focused on digital asset issuance, digital asset issuance, and they're really hyper-focused today on ticketing for live events. So think things like concerts, sport events, those kinds of things. The two biggest problems in the ticketing industry are first fraud, just people printing multiple tickets and reselling them on the street, and the second is scalpers, right? There's limited supply, people buy them up, resell them at a large profit. This is value destructive for the artists, the venues, and the consumers, right? And so Tari realized there's a huge opportunity to reimagine the future of ticketing, and they thought they could build it on Web 2 or Web 3. The Tari founders are some of the best entrepreneurs to come out of the music business. Naveen, one of the founders, previously ran technology for artists like Linkin Park, Lil Wayne, and others. Dan Turi, another one of the founders, he previously founded Ticketfly, which sold to Pandora for $450 million. And the third founder, Riccardo Spagni, previously created the Monero cryptocurrency, which is one of the oldest and now most valuable cryptocurrencies out there. These are some of the best caliber entrepreneurs in the coming out of the music industry, and they thought to themselves, are we going to build the future of ticketing and live events on top of Ticketmaster, or are we going to build it on top of an open protocol and platform? And that's why they built Tari. Big Neon is now a consumer-facing application that is live on top of the Tari protocol today. There are consumers using Big Neon in 3 cities, and they're going to be in more than a dozen by the end of this year. So this is all happening today. Beyond examples like Tari and Big Neon, though, building out this Web3 vision is going to take a lot of energy and effort. All of the technology that's been built for cloud and SaaS over the last 10 or 15 years has been based on the fundamental assumption that we will bundle data and application logic. And so if we're going to break apart that assumption, we need to rethink all of the core software and infrastructure that makes applications possible. And so we are investing now aggressively in applications like Tari and Big Neon, and in a lot of the underlying infrastructure to make Web3 happen. So we've made 7 such investments to date. Some of these teams are building protocols. Some of these teams are companies. And I'd like to highlight just one of them to give you a flavor of what that means. I'd like to talk about Textile. So today, to understand what Textile is, consider one of the best features of modern web applications. And that's that as you move between your devices, your phones, your tablets, and your desktops, all of your data syncs magically between all of these devices. And it turns out there's a lot of complexity to make that happen, right? The databases on the back end need to manage devices, authorizations, doing all the syncing, keeping everything up to date. It's a really complex process, and that all now happens magically. The 2 largest providers of that service are Apple through iCloud and Google through Firebase. And again, all of that now works seamlessly. If we're gonna, but all of that logic is based on this fundamental assumption that data ownership and application logic are bundled together. And if we're going to break that assumption, then we need a whole new technology stack to enable all of this cross-device syncing and user authorization to work seamlessly. And that's what Textile builds. And so that's the kind of thing we're investing in today to make Web3 work. And if we're right, and if Web3 does happen, then hopefully teams like Textile, right, their services are going to be used by billions of consumers. Okay, so we've covered a lot. We've talked about how we can rethink trust and money through open finance, and we've talked about how we can rethink more broadly data ownership and application logic through this kind of crypto backbone. The last, though, trust assumption we haven't really talked about is the actual trust we place in our governments, and this is the largest source of trust out there. So if you think about fiat money, kind of as a point of principle, fiat money is not bound by math or physics. Fiat money is bound by human institutions. It is bound purely by trust. And we trust these institutions to manage the money supply well. Sometimes they do a good job, sometimes not so much. But it turns out actually when they do a bad job, it's really catastrophic for the people in those economies and in those countries. And yeah, here in the US, they've done a reasonably good job, depending on how QE works out over the last 10 years, but they've done generally a reasonably good job. But there's a lot of people around the world, about 500 million people to be precise, who live in countries that the government has not done a great job, and that these people have very good reason not to trust their central banks and to not trust their governments. These people, as you can see, don't really live in economies with advanced financial capital markets, and so these people cannot really practically store their wealth in assets that are non-inflationary. And so these people, right, their net worth is being reduced by 10, 20, 30% every single year, and there's not a lot they can do about it. The solution to this historically, of course, is obvious. It was to use a money backed by physics and math, and that is a fundamentally scarce thing, and that is gold. Now, of course, the problems with gold are pretty clear. Can't really lug it around, can't break it up into small pieces, a lot of pretty obvious logistical problems. And so the opportunity for crypto is to have an open money system with an auditable supply schedule that cannot be manipulated by governments, right? And that is divisible and transportable and all these benefits. And it's pretty clear that cryptocurrencies at a minimum can provide quote unquote digital gold functionality and be meaningfully usable, which gold today is, for all practical purposes, not. But this is actually really market expansionary because we enable new people to hold these things and we enable them to be used in new kinds of ways. We think there are at least 4 major ways that by digitizing gold, we expand the market dramatically such that you shouldn't even think about it as gold anymore, but you should think about it as just a global money. And so the first is, as I just talked about, the people who need this the most are the people who cannot access this. This is actually very comparable to the way that Uber expanded the market for taxis. In 2008, it was estimated the market for taxis were on the order of about $100 billion. And so as Uber started to cross the $1 billion, $2 billion, $4 billion threshold, there were a lot of people who rightfully questioned and said, why are investors assigning such a large multiple to this company, right? The market's just not that large. And the problem with this fundamental line of reasoning was that Uber increased the market by A, making it easier to consume taxis, but then B, by actually taking market share away from other forms of transportation, right? And so it turns out the market for transportation services now maybe is $1 trillion or $2 or $3 trillion, right? And so it's on the order of 10x larger than the market was previously. And in the same way, the people who today need a inflation-resistant sort of wealth are the people who cannot access one. And so if gold is $7 trillion today, right, as billions of people get access to these things, we should expect this market, this opportunity to grow exponentially from the status quo. Counterintuitively, at the other end of the socioeconomic spectrum, the richest people in the world also have a very good reason to use crypto. The richest people in the world always want insurance policies against tail risk. And one of the greatest sources of tail risk is government seizure of assets. And so these people today spend a lot of time and energy storing their wealth in all kinds of creative places. It's estimated there are now $20 to $30 trillion of capital stored in offshore bank accounts. The opportunity for crypto then very clearly is effectively a Swiss bank account that's in your head. It is the most seizure-resistant asset that's ever been created. Third is the opportunity for actually having an organic risk-free rate in these systems. So a lot of famous investors like Warren Buffett say they will never buy gold because gold does not produce a yield. And that's right, gold just sits there and doesn't do anything. You might be able to lend it out, but you have some counterparty risk. Well, cryptocurrencies, similarly, there's a whole other class of investors that they will, for example, not buy stocks that do not pay a dividend. And so those kinds of investors have simply missed companies like Amazon over the last 10 years or longer. Our point in bringing this up is that because cryptocurrencies offer an organic yield that is risk-free technically in their respective ecosystems, that unlocks huge amounts of new capital that can enter these ecosystems. This works both for proof of work and proof of stake systems. In Bitcoin, which is proof of work, you can provide routing fees in the Lightning Network and generate fees. And in proof of stake systems like Ethereum 2.0, you'll be able to stake your coins and generate more returns. And so again, we think there's trillions of dollars of capital that they've never conceived of owning precious metals because it fundamentally violated their investment mandates. And because these things offer yields, that can unlock trillions of dollars of net new capital. And the fourth major way we think this is market expansionary is by looking at what's going to happen over the next 10 years with open finance and with Web3. Huge amounts of new value are going to be created on top of these open distributed networks. And the people who create that value and unlock that value, we expect a lot of them are going to choose to store quite a bit of it in this global trust minimized money rather than one that's based on trust in human institutions. And so that is going to again compound and flow over the next decade. And so when we add all of these together, we think conservatively this sets the opportunity at 40 trillion and could be as high as 100 trillion or even more. Right? This is massively market expansionary from the status quo, and that's why we're so excited about crypto. Okay, and with that, we've touched on the three mega theses for crypto. But I'd like to wrap up by talking about trust for just a few minutes. The economy is a beautifully complex machine. That it works at the scale that it does is really a testament to the power of human institutions. But sometimes those institutions fail. They fail in small ways, like when Marriott or Target get hacked and we have to go cancel our credit cards and get new ones. In bigger ways, like when governments use social media to influence elections. And in really catastrophic ways, like in the financial crisis in 2008, 2009, which happened to also be at the birth of Bitcoin. For the first time in human history, we have a way to incentivize large-scale human cooperation and coordination without creating any new trust assumptions. And that is the really subtle and profound breakthrough. The transition from a trust-based economy to a trust-minimized one is going to unlock one of the largest wealth transfers in human history from these institutions that are trusted to free market participants on the edge of these networks. Trust is the foundation of the modern economy. The greatest investment opportunity of our lifetimes is betting that it doesn't have to be. Thank you all very much. And just a couple of small things. We will be posting a video of this on our website next week, along with a blog post kind of outlining this all in a written format. And do I have time for Q&A? Yeah, I have a few minutes for Q&A. I know that was a ton of material. So happy to answer any questions.
I just had a question on the UMA protocol that you brought up. One of the premises of that is that you're going to be allowed to hedge the risk through the actual exchanges, and obviously the Chinese government is very restrictive on capital flows. So if they decide to no longer allow that central server to hedge their risk, doesn't that bring down the whole system?
Certainly, theoretically, yes, but in practice, we can already see that there's a lot of people who bridge capital through China, right? They have access through Hong Kong or through offshore wealth. So we already have there's already a lot of people who have operated in China and have capital outside of China. And so they can effectively hedge already, right? And that capital is not going to, I think, re-enter China. I think for the most part, the Chinese capital that has money outside of China is likely to keep it outside of China. Any other questions? No? All right, guys. Well, thank you all again. I know there's a ton of material. We'll post it all for you next week. And looking forward to the rest of the content today.